In today's video, I am going to be reviewing the BMO Canadian Dividend ETF ZDV on the Toronto Stock Exchange. This is actually a very interesting ETF, and it's one that I've been looking to break down this year as well. Because of all of the stuff that's been happening in this world, it's quite interesting. So let's get down and let's actually check this out. So first off, it has a 4.27% dividend, which is actually quite good. The reason why this is good is because even though interest rates have been rising, your interest rate is still not that high in bank accounts. So this is why you would want to be looking at a higher dividend ETF so that you can basically not have to be worried about a single individual stock. That's why ETFs are good, but also it allows you to get a higher dividend than what you would be paid with interest. Now, of course, there is the risk of losing the money, but you are protected because there's multiple companies inside of an ETF. Now, there is an expense fee. It's 0.35%. The reason why this is actually quite important is because now you have to understand that while you put your money in a savings account, it's not costing you anything. But if you invest your money in an individual stock, it's not costing you anything. However, technically it is. When you buy a stock, some trading apps will cost you or have you pay $10 per trade. There is that, but what an MER is with an ETF, it's free to buy and sell. Obviously, there's some rules and regulations in that. However, when it comes to that 0.35%, what you're looking at is it costing you, let's say you put out like $1,000 in, it's costing you essentially $35 a year to have that investment. But what you're hoping for is the actual cost of the ETF to go up so that that $35 that you're losing doesn't matter. It's currently trading at around $19.40 a share, and its volume right now is lower than its average, so it could be an interesting time to buy. It just shows that there's not much interest in this specific ETF or in the market at wide right now. Just like the Canadian bank stocks, this is trading within a range, and it's kind of in the middle of its range right now, and it looks to hit pretty well a solid bottom, at least in the close term. It's also hit this bottom right here, roughly around the same amount twice. So this could be quite interesting as a potential double bottom. In fact, at the time of recording this video, Russia, Saudi Arabia, and a few other oil states have said that they are going to be cutting back production. Of course, Canada has usually a lot of oil production, so this could artificially help the Canadian economy, at least as long as we can pump oil and get the oil outside of our country to actually sell it. So we're looking at the government at this point to see if they will make it any easier, but I doubt it. The other thing that you want to look at is the dividend. This is obviously a dividend ETF, and it does pay every single month. So what you want to do in this circumstance is, of course, look year over year. So if we look at December to December, there was a dividend increase, which is exactly what you want to see when it comes to a dividend ETF. If an ETF that says it's a dividend ETF is not raising its dividend, it's probably not a good ETF to buy. Or if it's a stock that prides itself on a dividend and it just cut it, probably not a good stock to be in. Actually, if somebody's cut their dividend, it's definitely not a good stock to be in at that point. And then if we look back into history, September 17 to 18, they did not increase their dividend. However, they did what looks to be a special dividend right here, at least a bit higher than normal. So that's quite interesting too. That was back in 2018. Now, when we look at the top 10 holdings, this is actually equal to about 45% of the total holdings inside this ETF. It really is no surprise why this was trading inside of a range. Bank of Montreal, Bank of Nova Scotia, CIBC, as well as Royal Bank of Canada and TD are all 5 out of the top 6 banks in Canada are all in its top 10 holdings. And Canadian banks, if we've seen my most recent video, are trading within a range right now, just like this ETF. So if oil does go up in price, which it probably will, and I'm not talking about the price at the pumps where the Canadian government put just a random tax, a stupid tax on there, and then still tax the tax with GST. But either way, they right now are raising the price of oil, not the government of Canada, but Saudi Arabia, Russia, and all those oil nations, because they want to basically try and hurt one or the other, either try to hurt the American economy, European economy, because we run on oil and most of us are getting our oil from them, because our governments just don't want to be pumping it because of environmental reasons. And they want to try and either hurt us or try and make more money because they know we're not pumping anything, or at least hardly anything at all. So if we actually look down here, CNQ is on here, oil prices are going up. Enbridge is on here, they're more of a gas pipeline play. However, they do some green technology like solar panels, wind farms, things like that. So some of these options are actually quite interesting. There's BCE, which is Bell. I'm not a big fan of them, even though this house is currently ran on Bell. But I think eventually companies like Starlink are going to probably eat their lunch eventually. But that's probably 20 years down the road. Anyways, I hope that this video has helped you. This ETF is very interesting. I don't currently invest in it myself, but people in my family do. Anyways, I hope that you've enjoyed. Hit that like button, subscribe. Make sure not to trust any random person online or those Bitcoin comments down below. I'll see you guys again next time.